morning, Noopers. I am here with Doug Shipp, and this morning we're going to be talking about insurance and how it is impacted by some of the new regulations that we talked to Kyla about earlier.
Good morning, Adoni. Thanks for having me. Again, Doug Shipp with Assured Partners. Appreciate being here this morning.
We're going to jump in and talk about a few different things. Yesterday when I was talking with Kyla, I was talking about an interaction I had with a representative who he was absolutely awesome. He's actually in his last term. And he came into a meeting that I was in and he kind of apologized for this legislation. And he explained that the Florida legislature only has 60 days to try to pass huge monumental things that impact our everyday life. And 60 days is not enough time. And so usually stuff goes awry and then they keep trying to fix it with glitch bills. And so this is another glitch bill. During our discussion, insurance came up. And one of the things we were talking about was the change to 718 that House Bill 913 did, which I believe allows a condominium association to not have to insure for the full appraised value. So historically, we have hired companies like Townsend, or there's any number of them that are out there, and they provide us with a solid number, and then we insure to that number. And the insurance rate is usually predicated on that number. And then each year we get an appraisal update, or maybe every 3 years. It depends on how that works. That number has two very big impacts to us as managers and for our association. One of those impacts is the premium. The more a building is worth, the more that they have to insure for, the more the premium is. The other impact is to the deductible, because the deductible for a hurricane is oftentimes a percentage of that total insured value. So the higher the amount of the insured value, the higher the deductible. And on the surface, I thought this was fantastic, because what I thought was going to happen is we no longer are going to have to insure to 100% of the value. We're going to insure to this theoretical value that's more realistic for a loss. And that's great, right? Because it's going to lower our deductible and it's going to lower our premium. And now I feel like I'm the state legislature because this was a great idea. I was all for this. And now I'm starting to realize a number of complications that have come in on it. So the first complication is, what is that value? So we have a building, we have an appraisal that came in for $8 million. How much do we insure for?
Right, yeah. So there are in our industry some software programs that do what I'll call PML, an acronym for probable maximum loss. And these software programs kind of put all the characteristics of a structure, location, age of roof, type of construction, proximity to water, into the software program and determine, in a worst case scenario, what the probable maximum loss is going to be. Now, insurance company underwriters utilize this information to aid in the pricing of their product. More so, they probably use it in the pricing of a product in what we call a loss limit type program, which is kind of what we're talking about here. Meaning, if you have a building that's appraised at $10 million, a PML might say the probable maximum loss for that building might be $5 million. So the software program will kind of aid the insurance company underwriter in that process. So it's something that's been around for quite some time. And we actually I have seen personally, in some situation, where lenders, for example, for some hotel clients have accepted less than replacement costs, whereas historically they always wanted to see 100% of replacement cost. So we've seen that more recently in a few areas of business where lenders have been agreeable to something like that. You know, this in the insurance world is relatively new. I mean, this was just passed effective July 1st. So, and I think the wording went from shall to may, so it allows potentially some flexibility as far as the association to make a decision. I mentioned to Doe earlier that it's probably going to be with input from the property manager, from the insurance agent, from legal, but ultimately a board decision. But there are some other considerations that will likely come into play. I mentioned earlier lenders. You know, will a lender for a unit owner accept less than the full replacement cost value? Historically, they have not. Now, you know, the association is making a decision based on the statute, whereas a unit owner is securing a loan from their lender. The association's response to that could be like some has been with regards to flood insurance, where associations did not buy flood insurance. That's the unit owner's problem. Tell them to go out and get a different lender. I mean, but lenders historically have required that you insure to the full replacement cost value from both a hazard or property perspective and also from a flood perspective too. There are co-insurance clauses in contracts. So insurance companies, a big bugaboo for them, probably ever since Hurricane Irma came through, is insurance to value. They want to make sure that you are insuring your property to the replacement cost. Many carriers historically haven't deviated from that. We do find, I think, as the market becomes a bit more consumer friendly, you find insurance companies, first compete on price, then compete on terms, then they might start competing on, being receptive to insuring less than the full replacement cost. So I'll say yet to be determined, because this has just happened. Historically, they've not been willing to do that. They want you to insure to the replacement cost based on an appraisal that was computed within the last 36 months. And in some cases, they determine their own insurance value. They don't even agree with the appraisal. In some cases, like Heritage, who a lot of associations have, increase the values with inflation guard every year. Some, like American Coastal, will actually refuse to use an appraisal that's come in less than what the one the year before was. So again, that's to be determined. As far as the co-insurance, it can be complicated. But every insurance contract has an insurance to value requirement, or a co-insurance clause. Now, many of them we strive, as most agents strive, to get what is called agreed value, to suspend our way to co-insurance clause. But I suspect if you have a $10 million building that you're going to choose to insure for, $8.5 million, the insurance company is going to put a co-insurance clause in that contract. And there's a potential penalty if you're not insured to value at the time of loss. So from an admitted market perspective, which is most of your carriers that do your garden style, 2, 3, 4-story type product, Heritage, American Coastal, Frontline, First Protective, meaning admitted market and also not admitted markets that play in that space, Zurich, U.S. Coastal Orange Insurance Exchange. My personal opinion as of right now is I don't think they're going to be inclined to offer less than insuring for full replacement cost value. That's as of today. As the market continues to improve the consumer, you might find they might become a little bit more flexible. So just a few considerations, kind of outside the space of what the statute states. I mentioned to Adoni, I actually printed out the Declaration of Condominium for 4 associations that Newell Property Management handles here, and all 4 read a little differently. One of them actually says insure per the statute, so it's quite clear. Just go to whatever the statute says. Others, though, still have their own wording that says you must insure to the replacement cost. You know what I mean? So that's kind of another thing that's going to have to be dealt with, because my understanding, and more a question for legal counsel, is that the statute trumps the Declaration of Condominium, but the Declaration of Condominium can go above the statute if it's an improvement for the association, but not below what the statute requires. Hopefully that's been helpful.
You mentioned talking to legal counsel on it. I think what we're going to end up doing is actually getting legal counsel and our insurance agent together, because the insurance agents are unsure about the law and the legal counsel is unsure about everything outside of the law. And I think this is going to be a lot of what's come from this statute. I think there's going to be a lot more teamwork between insurance agents, attorneys, bankers, and engineers. I think we're going to start having, and property managers and the board. I think there's going to start being this 6-member dream team of trying to figure out how to.
Agreed. I mentioned that kind of from the outset. And you're going to get into situations where, one legal counsel may have a different interpretation than another legal counsel. And
that's why we call it an opinion.
Yeah, it's an opinion. Yep. It's an interpretation by them. So we encountered that with the flood map changes in, February 20. We had some association declaration of condominiums that said the association may purchase flood insurance. Others said it's completely up to the board. Others said they have to purchase flood insurance. And we got opinions from association attorneys on some of those that said you may purchase flood insurance. One said, well, that's up to you. The other one said you have to. So again, it's an interpretation or opinion of the statute, in that case, of the Declaration of Condominium. Same thing. So to be determined, it's something that's going to, evolve a little bit as we get deeper into it.
It depends. That's become the latest answer with all of our statutory changes. It depends.
Yep.
Next up, we're going to talk about structural integrity study, the SIRS milestones, and how carriers are reacting to buildings that haven't yet reached it.